When we picture the legendary investors of the 20th century, the billionaires who uh, essentially built modern global finance, we usually default to a very specific archetype.
Oh, absolutely. The tailored suits, the aggressive Wall Street boardroom vibe.
Right, the cutthroat alpha mentality of someone who just always has to dominate the room. But today, we're doing a deep dive into a contrarian mind that completely shatters that mold. We're looking at Sir John Templeton.
A truly fascinating figure.
Yeah, I mean, back in 1999, Money Magazine called him arguably the greatest global stock picker of the century. And our mission today is to extract the core wisdom from this guy. We're pulling from his famous 1993 16 Rules for Investment Success, a bunch of biographical data from Wikipedia and Quivira, insights directly from the Templeton Foundation, and, some hard historical market analysis.
And what's really wild as we synthesize all these sources is how he essentially weaponized radical humility to beat Wall Street at its own game.
Exactly. Okay, let's unpack this. I want you, the listener, to picture a college student in the 1930s. The Great Depression has just crushed the economy. His family loses their money, cutting off his financial support. But he doesn't drop out of Yale.
Right, he stays.
He stays. And he helps pay his tuition through odd jobs, scholarships, and by absolutely dominating at the poker table.
Which is such a great detail.
It really is. He develops this incredibly disciplined, calculated approach to risk assessment while holding a hand of cards. Now, take that same person, scale up those precise unemotional risk assessment skills, and point them at the global equities market.
What's fascinating here is that Templeton wasn't just relying on a gambler's instinct. He systematically formalized his understanding of risk, probability, and human psychology.
Okay.
When he launched his flagship Templeton Growth Fund in 1954, he created an investment vehicle that averaged over 15% growth annually for 38 straight years.
That is just a staggering number to maintain for almost 4 decades.
It really is. To give you a sense of the sheer compounding power of that run, if you had invested $10,000 in his fund in 1954 with dividends reinvested, that single investment would have grown to $2 million by 1992.
Wait, $2 million from 10 grand?
From 10 grand, yeah.
Generating those kinds of returns requires a serious mechanism.
Yeah.
And to understand that mechanism, we have to look at how he formalized those early poker instincts into his most famous strategy, which was buying at the point of maximum pessimism.
It sounds like a poetic philosophy, but his application of it was ruthlessly mathematical, and it required an iron stomach.
Oh, for sure.
The psychological barrier to executing this strategy is immense because human beings are biologically wired to run away from danger, right? Not invest their entire life savings into it.
Which brings us to 1939. World War II is breaking out. The global outlook is just utter catastrophe. Institutional investors and retail traders alike are terrified. They're liquidating assets, fleeing to cash.
Complete panic.
Complete panic. But Templeton goes the exact opposite direction. He borrows $10,000, which, by the way, is roughly $700,000 in today's money.
A massive loan for a young guy.
Massive. And he instructs his broker to buy 100 shares of every single company on the New York Stock Exchange, currently trading for under $1.
Yeah, that sweeping directive resulted in him purchasing stock in 104 different companies.
And 37 of those companies were already actively in bankruptcy. I have to push back on the logic here. Buying shares in 37 bankrupt companies when a global war is starting.
It sounds crazy.
It does. That doesn't sound like calculated investing. That sounds like buying a lottery ticket on a sinking ship. How is that functionally different from reckless, desperate gambling?
Well, it looks like gambling if you evaluate a single distressed company in isolation. But Templeton was looking at the macroeconomic board.
Okay.
The mechanism here is diversification combined with extreme optionality. It's what he called safety in numbers. By spreading that borrowed capital across 104 microcap and distressed companies, he wasn't betting on any specific sinking ship. He was making a broader mathematical bet that the ocean itself would eventually calm down.
So he's betting on the environment, not the individual boat.
Exactly. His underlying thesis was that the sheer scale of a wartime economy would inevitably force U.S. industrial mobilization, which would lift the entire sector. Out of those 104 companies, only 4 turned out to be completely worthless.
Wow, only 4.
Yeah. By holding the rest as the wartime economy ramped up, he quadrupled his money, turning that 10 grand into $40,000.
So he was betting on a systemic recovery, completely removing his own bias about which individual corporate management team would actually survive.
He was heavily influenced by the mechanics of value investing.
Hmm?
The mathematical reality is that you cannot outperform the crowd if you buy what the crowd is buying.
Right.
If you buy the consensus, your returns will exactly match the consensus. Templeton realized that true mispricing only happens when collective panic drives asset prices significantly below their intrinsic recovery value.
And he didn't just deploy this in domestic markets. He took this contrarian philosophy global long before international investing was standard practice.
Oh, he was way ahead of his time there.
In the late 1950s, the global financial community viewed post-war Japan as this devastated, radioactive economy to be completely unweighted. But Templeton bypassed the geopolitical sentiment and looked strictly at the underlying numbers.
Which were incredibly compelling if you actually looked.
Right. He saw an emerging market with massive industrial output, where fast-growing companies were trading for a fraction of their actual value, sometimes just 2 or 3 times their earnings.
He was acquiring equity in future global titans like Toyota and Matsushita, which we now know as Panasonic years before institutional money realized what was happening. The valuation disconnect was so extreme because Western capital simply refused to look there.
He was so early to the Japanese market that the sources mentioned he actually struggled to find bilingual stockbrokers to even execute the trades.
That's how contrarian he was.
Seriously. And by 1970, he had conviction-weighted his portfolio to the point where 60% of his entire fund was invested in Japan. But the real masterclass isn't just identifying the entry point, it's recognizing when that maximum pessimism has inverted into maximum euphoria.
Right. This raises an important question about market cycles and capital flow. As we moved into the 1980s, Japanese stocks became the hottest asset class on the planet. Western capital flooded in, valuations skyrocketed, and the market became wildly disconnected from fundamental earnings.
It became a huge bubble.
A massive one. But Templeton didn't hold on out of loyalty to his initial thesis. He systematically rotated his capital out as the multiples expanded. By the time the catastrophic Japanese asset bubble burst in 1989, he had minimal exposure.
Wow.
Yeah, he had already repatriated that capital to the United States and other markets where multiples were compressed.
Now, I want to make sure we don't paint a distorted picture for you listening. Templeton wasn't just indiscriminately buying distressed garbage solely because it had a cheap price tag.
Definitely not.
He had an incredibly strict, unforgiving definition of what actually constituted value. And that definition was forged by the harsh, erosive realities of inflation and taxation.
Rule number 1 of his 16 rules is to invest for maximum total real return. He viewed traditional fixed income safety not as a safe harbor, but as a guaranteed wealth destroyer over a long enough timeline.
So what does this all mean? He's basically looking past the nominal dollar amount on the portfolio statement.
Yes, the nominal balance is a psychological trap. If you are ignoring the dual headwinds of inflation and taxes, you're operating blind. Templeton laid out the math in his 1993 rules. If inflation averages 4%, a $100,000 portfolio drops in actual buying power to $68,000 in just 10 years.
That is brutal.
It is. Your portfolio has to generate a 47% gain over that decade just to tread water and maintain your original purchasing power. And that calculation doesn't even account for capital gains taxes.
Which means chasing a 12 or 13% equity return isn't about greed. It's a mathematical necessity just to outrun the erosion of the currency.
Exactly. That's why he advocated so forcefully for common stocks as a defensive shield. But as you noted, he demanded quality. He vehemently warned against treating the equities market like a casino.
Right. Day trading and all that.
Yeah, dealing heavily in short-term options, flipping IPOs for quick pops, moving in and out of positions on single-point shifts. He argued that these behaviors guarantee you will eventually be beaten by the house.
He hunted for what he called bargains among quality stocks, and his parameters for quality were deeply structural. Entrenched sales leaders, technological innovators with a moat, heavily capitalized balance sheets, and proven management teams.
He was looking for asymmetrical setups, high intrinsic quality that the market was temporarily discounting due to macroeconomic noise.
Let me try a different analogy for this. Rather than just saying he bought cheap things, it's like finding a fully operational, highly profitable manufacturing plant that is priced at a massive discount simply because the single road leading to it is temporarily under construction.
That's a great way to put it.
Yeah, the crowd sees the traffic jam, panics, and sells the asset. Templeton looks past the temporary supply chain bottleneck, values the factory's actual output, and buys.
That captures the mechanism perfectly. And it underscores why he insisted on valuing individual businesses rather than trading based on broad economic outlooks.
Right.
Macroeconomic bear markets do not perfectly overlap with the performance of individual equities. You are buying a fractional ownership in a specific cash-flowing business, not buying a proxy for the entire GDP.
So assuming you execute this correctly, you screen the market, you find these deeply discounted high-quality companies, and you allocate your capital. Do you just lock them in a brokerage account and ignore them for 30 years?
Oh, absolutely not. That is the fatal flaw of passive buy-and-hold dogmatism. Templeton's Rule 9 explicitly states that you must aggressively monitor your investments. The pace of creative destruction in the market is just too severe.
The sources highlight a terrifying statistic on this exact point. Between 1983 and 1990, which is just a 7-year window, 30 of the top 100 Fortune companies dropped off the list entirely.
A third of them.
Yeah, 1/3 of the largest, most entrenched corporations on the planet disappearing from the top tier via mergers, acquisitions, or outright bankruptcies in less than a decade.
Complacency is just as dangerous as panic. You have to assume the landscape will shift. Templeton famously stated that the 4 most costly words in the annals of investing are, "This time is different."
The ultimate psychological rationalization for an asset bubble.
Always. Whenever market participants convince themselves that historical valuation metrics no longer apply because some new technological paradigm has arrived, capital destruction inevitably follows. He relied on this principle to completely avoid the late 90s dot-com bubble. You had the NASDAQ trading at a PE ratio of 200. Individual tech equities were soaring 1,000% in a single calendar year.
It was madness.
And the consensus narrative was that the internet changed the fundamental rules of corporate valuation. Templeton's historical data proved it didn't.
Here's where it gets really interesting. If his mandate is to aggressively monitor the portfolio and react to change, how does an investor execute that without crossing the line into the frantic casino-style overtrading he explicitly condemned? It sounds like a paradox. Ignore the noise, but constantly watch everything.
It's a vital distinction, though. Aggressively monitoring your portfolio does not mean staring at the intraday ticker tape and sweating over fractional price volatility.
Yeah.
It means constantly auditing your original investment thesis. Are the fundamentals still intact? Is the balance sheet still capitalized? Has a competitor breached their technological moat? You are aggressively auditing the underlying business model, not reacting to the daily mood swings of the broader market.
So it's an audit of the business logic, not the stock price.
Precisely. And this framework is what drove his legendary advice during the 1987 Black Monday market crash. When global equities were entering a freefall and investors were staring at 15% losses in a single trading session, his guidance was remarkably stoic. He said, "The time to sell is before the crash, not after."
Think about your own portfolio during the 2020 pandemic crash or during a severe, prolonged tech slump. Templeton is essentially asking you to look at your bleeding portfolio, remove the emotion, and ask a highly rational question.
He forced investors to invert their thinking. He advised them to look at their holdings the morning after a crash and ask, "If I didn't own these stocks today, at these newly discounted prices, would I buy them?"
Wow.
Because prices just compressed by 15 or 20%, the mathematical probability is that the value proposition has actually improved. The only logical mathematical reason to liquidate a position after a severe drawdown is if you need to free up capital to purchase other equities that have been discounted even further.
So if you can't find better bargains, just hold.
Exactly. If you cannot identify better asymmetric bargains, your only logical move is to hold.
And if you make a mistake, you hold on to the lesson. He viewed errors as tuition paid to the market. He argued that the only way to completely avoid investment mistakes is to never invest your capital at all, which, due to inflation, is the single greatest mathematical mistake you can make.
You extract the data from the failure, you figure out exactly where your thesis broke down, and you adjust your future risk models. He believed that the primary differentiator between successful and unsuccessful allocators is the capacity to internalize their own errors.
That willingness to rigorously reassess his own knowledge, to admit when his models were wrong or when the macroeconomic environment had shifted. I mean, as we synthesize these sources, it becomes incredibly clear that this wasn't just a portfolio management tactic.
No, it was much bigger than that.
Yeah, his radical intellectual humility was the architectural foundation of his entire life, culminating in his massive philanthropic footprint.
It was the operational through line of his existence. The same humility that allowed him to see mispriced assets in post-war Japan drove how he engaged with the fundamental mysteries of the universe.
Rule 12 of his investment guide is literally begin with a prayer. He utilized it as a focusing mechanism to clear bias and make fewer unforced errors. And Rule 14 distills his entire philosophy. An investor who has all the answers doesn't even understand all the questions.
He termed it a cocksure approach. Approaching the market or life with absolute certainty blinds you to new data. Success requires an ongoing process of seeking answers to continually evolving questions.
And despite amassing this multi-billion-dollar fortune, despite pioneering global equities trading, his lifestyle remained aggressively frugal.
Oh, incredibly so.
He drove his own car. He refused to fly first class. My favorite detail from the biographical data is that he would literally cut up used computer paper to bind into his own notebooks to avoid wasting money on new stationery.
He had a visceral aversion to debt and an almost Calvinist reverence for thrift. A colleague once noted his belief that generating wealth was perfectly acceptable, provided you didn't actually indulge in it.
That same willingness to defy the crowd on Wall Street eventually led him to defy the expectations of American high society altogether. Which brings us to a highly debated move in 1964, when Templeton formally renounced his U.S. citizenship, moved to the Bahamas, and became a naturalized British citizen.
Right, the Bahamas move.
Yeah, looking at the historical data, there are two distinct narratives surrounding this decision. On one side, financial historians point out the immense tax implications, noting that because the U.S. taxes global income regardless of residency, this move saved him an estimated $100 million in capital gains taxes when he eventually sold his fund.
And it is a structural reality of the U.S. tax code that makes expatriation one of the only methods to shield massive liquidity events.
Exactly. But it should be noted, he immediately redirected that saved money into his charitable foundations. And on the other side, Templeton fiercely disputed the tax evasion narrative. In interviews later in life, he explicitly denied that capital preservation was the motive, stating that the Bahamas actually had a higher effective tax burden than the U.S. at the time of his move.
Interesting.
His stance was that he simply intended to live out his life in the Bahamas and felt an ethical obligation to hold citizenship in his physical home. So we're just reporting what the sources say there.
Of course. And whatever the internal calculus was for that decision, the tangible output of his wealth from the Bahamas is a matter of public record. He deployed over $1 billion into philanthropic initiatives.
$1 billion. And the structure of that philanthropy was deeply intentional. He established the Templeton Prize, and he deliberately structured the endowment so that the monetary payout, which currently sits at around 1.1 million British pounds, always exceeds the payout of the Nobel Prize.
That financial structuring was a direct philosophical statement. He was utilizing capital to forcefully argue that advances in spiritual understanding or the exploration of human purpose are of equal or greater importance to human progress than advances in hard sciences like physics or medicine.
He called his worldview humble theology. Despite serving on the board of the Princeton Theological Seminary for 42 years as a dedicated Presbyterian, he completely rejected rigid dogma. He would regularly attend Hindu and Muslim services. His operating thesis was, if you are not egotistical, you will welcome the opportunity to learn more.
If we connect this to the bigger picture, the John Templeton Foundation was explicitly engineered to attack the friction between two domains that traditionally view each other as enemies: empirical science and religion. He operated on the premise that scientific inquiry was the primary mechanism for uncovering the nature of God.
He deployed hundreds of millions of dollars to fund empirical, rigorous research into the genetics of human behavior, the neurological basis of love, and the psychological impact of gratitude. He viewed this data as new spiritual information.
It's a fascinating approach.
The parallel to his investment strategy is just staggering. Just as he believed there was always hidden, mispriced alpha in ignored international markets, he believed the universe was filled with hidden, profound truths waiting to be discovered, provided you had the humility to look where the mainstream establishment refused to look.
He was systematically financing humility. By applying the unforgiving, undogmatic framework of the scientific method to spiritual questions, he proved his lifelong dedication to stress-testing assumptions and crossing boundaries.
So let's bring all of these threads together for you. We started with a college kid optimizing risk at a Depression-era poker table. We watched him leverage that exact mathematical discipline to borrow $10,000 and buy bankrupt equities during the sheer terror of World War II.
A truly legendary trade.
We tracked him pioneering international capital flows in post-war Japan when the rest of the world was looking away. And ultimately, we see him deploying a billion-dollar fortune to force science and faith into the same room.
Sir John Templeton's legacy is defined by a ruthless, mathematical refusal to participate in collective panic or collective euphoria. He demanded deep, structural quality in his portfolios, and he maintained a profound, driving curiosity about the outer limits of human knowledge.
Which brings us to a final contradictory thought I want to leave you with, something for you to mull over long after this deep dive ends. We analyze his warning that this time is different are the four most dangerous words an investor can utter. That entire defensive framework relies on the cynical, mathematical belief that human nature never actually changes, that our historical cycles of greed, panic, and irrationality are eternally predictable.
Right. It is the psychological bedrock of buying at maximum pessimism.
Yet, when we look at his later years, in 2005, he circulated a memo predicting radical, unprecedented global shifts, like the mass migration away from traditional institutions toward internet-based learning. And his entire billion-dollar philanthropic footprint was dedicated to the deeply optimistic belief that humanity is constantly evolving, highly adaptable, and capable of uncovering totally new scientific and spiritual realities.
It's a real paradox.
It is. So here's the question for you to explore on your own. If his unmatched multi-billion-dollar investment success relied on the cynical belief that human panic and greed never change, but his ultimate life's mission relied on the deeply optimistic belief that humanity is constantly evolving toward new discoveries, which one is true? Are we eternally depictable in our panic, or are we limitless in our potential?